Gold is not just a shiny metal. It is not just jewelry locked inside a bank vault. Gold is power. For over 5,000 years, gold has controlled empires, influenced wars, built economies, and protected wealth during the darkest financial crises in human history. Kings fought for it. Explorers sailed across oceans for it. Governments built entire monetary systems around it. And even today, in a world of digital payments, credit cards, and cryptocurrency, gold still holds its throne. But how did gold become so powerful? And why do investors still run to gold when everything else crashes? To understand that, we must go back to the beginning, where do trade? Ancient civilizations and the birth of gold power. The story of gold begins in ancient Egypt. The pharaohs believed gold was the skin of the gods. It symbolized immortality and eternal life. That is why royal tombs were filled with gold artifacts, statues, and burial masks. Gold was rare. It did not rust. It did not decay. To ancient people, that meant it was divine. Soon, gold became a symbol of absolute authority. Then came the Roman Empire. The Romans transformed gold from a religious symbol into economic power. They minted gold coins known as the aureus, creating one of the earliest standardized currency systems. This changed global trade forever. Instead of exchanging goods for goods, people could now use gold coins with universal value. Gold had officially become money. 230, 345, gold and the age of exploration. By the 15th and 16th centuries, European powers were desperate for gold. Spain, Portugal, and Britain launched massive sea expeditions, searching for new lands rich in gold reserves. When Spain found gold in the Americas, it became one of the richest empires in the world almost overnight. Ships loaded with gold crossed the Atlantic, but this sudden wealth had consequences. Too much gold entering Europe caused massive inflation. Prices skyrocketed. This was one of the earliest examples of how gold could both build and damage an economy. Gold was powerful, but dangerous. 45, the gold standard, money backed by metal. In the 19th century, the world made a historic financial decision. Countries began tying their paper currency directly to gold. This system was called the gold standard. Under the gold standard, every banknote printed by a government could be exchanged for a fixed amount of gold. Countries like the United States adopted this system to create trust and stability. This meant governments could not print unlimited money because they needed gold, reserves to back it. The system worked well for decades. International trade became smoother. Exchange rates were stable. Investors felt secure. But then came economic disaster. 45, the Great Depression and collapse of the system. In 1929, the stock market crashed. The Great Depression began. Banks failed, businesses collapsed. Millions lost their jobs. People panicked. They rushed to banks demanding gold in exchange for their paper money. Governments quickly realized a terrifying truth. If everyone demanded gold at the same time, the banking system would collapse completely. To stop this, many countries suspended the gold standard. Gold ownership was even restricted in some places. The world economy was changing, and gold's role was about to transform again. 1971, the Nixon shock. After World War II, a new system called Bretton Woods was created. The US dollar became the world's main reserve currency, and it was still backed by gold. But by the late 1960s, America was spending heavily on war and social programs. Too many dollars were being printed. Foreign countries started demanding gold in exchange for their dollars. America's gold reserves began shrinking rapidly. Then, in 1971, U.S. President Richard Nixon made a historic announcement. He ended the convertibility of the U.S. dollar into gold. This moment is known as the Nixon shock. From that day forward, money was no longer backed by gold. It became fiat currency, backed only by government trust. The modern financial era had begun. 845, gold in the modern economy. After 1971, gold was no longer fixed in price. It began trading freely in open markets. And something interesting happened. Whenever there was fear in the economy, gold prices rose. During inflation, gold rises. During wars, gold rises. During stock market crashes, gold rises. In the 2008 financial crisis, investors rushed toward gold as banks collapsed. Why? Because gold has no counterparty risk. It cannot default. It cannot go bankrupt. It does not depend on a company's performance. That makes gold a safe haven asset. Even today, central banks continue buying gold reserves. Because when trust disappears, gold remains. 8:45, 9:30. Gold versus digital age. Today, we live in a world of digital finance. Cryptocurrencies like Bitcoin are often called digital gold. They are limited in supply. They are decentralized. They are independent of governments. But gold has something crypto does not. 5,000 years of trust. Gold is physical. It cannot be hacked. It cannot disappear due to a software failure. While digital assets may represent the future, gold represents stability. And in times of uncertainty, stability wins. Final conclusion. Empires have risen and fallen. Currencies have collapsed. Stock markets have crashed. Technology has evolved. But gold has survived every major financial transformation in human history. That is why gold is not just a commodity. It is confidence. It is security. It is power. And as long as uncertainty exists in the world, gold will always shine.